Welcome back. You're tuning into episode 3 of our series, Mastering the July 2026 Nigerian Crypto Tax Guidelines, Important Rules and Costly Mistakes to Avoid. I am so glad we're figuring this all out together because today we're diving deep into sections 6.1, 6.2, and 6.3, all about applicable taxes. Listen, the rules have completely changed. The tax net, it's widened significantly. Staying informed is literally the only way to protect your digital wealth right now. So go ahead and hit that notification bell, subscribe to We in Law, and let's decode this new crypto tax reality together.
Here's our quick roadmap for today's explainer. We'll start with the new crypto tax reality, look at income tax for individuals, jump into corporate and non-resident rules, navigate value-added tax, break down the 1.5% stamp duty, and finally, wrap up with how to avoid those really costly crypto mistakes. Okay, Section 1, the new crypto tax reality. Let's get an overview of Section 6.
So the absolute biggest shift you need to grasp right out of the gate is that Nigeria is officially moving away from this sort of Wild West approach, right? We're entering a highly structured tax regime. Section 6 explicitly states that a single transaction might trigger multiple, completely separate tax liabilities. It's not just a singular event anymore. For instance, if you're cashing out your Bitcoin for Naira, that isn't just a basic capital gains event. It's actually a combination of different obligations depending on the exact action. You could be looking at income tax, stamp duty, and even VAT on the exchange fees, all hitting you at the exact same time.
Moving on to Section 2, income tax for individuals. This falls under Section 6.1.1.
Now, building into this first major category, if you thought the tax man was only looking at capital gains from your day trading, well, you might want to sit down for this list. The tax net captures absolutely everything. Yes, gains on the disposal of virtual assets are in there for sure, but look further down the list. We're talking employment income, professional or consultancy fees, even mining and staking rewards. They've even included DeFi rewards, liquidity mining incentives, yield on your investments, and get this, taxable airdrops. Seriously, if you're a freelancer getting paid in USDC, or you're just staking some Ethereum to earn rewards, the new guidelines firmly classify all of that as taxable income under the Nigeria Tax Act. No exceptions.
So, the really crucial point we have to figure out here is, when exactly is this tax calculated? Because, as we all know, crypto is highly volatile. Well, the guidelines are crystal clear on this. Income is recognized at the fair market value, or FMV, of the asset on the exact date you acquire unrestricted ownership. And for those of you earning a salary in crypto, listen closely to this part. Employers are legally required to report that remuneration and its exact FMV in US dollars right at the payroll date. The reporting burden is officially on your employer to document that exact value at the exact moment those tokens hit your wallet.
All right, Section 3. Corporate and non-resident taxes, covering sections 6.1.2 and 6.1.3.
Shifting our focus over to companies deriving profits from virtual asset transactions. The taxable profits here include revenue from operating exchanges, transaction fees, brokerage commissions, custody and wallet administration services, and even token issuance. Now, what really surprised me when reading this is that virtual asset service providers, or VASPs, have to bear their own corporate tax, which can be up to 30% on these revenues. This is a totally separate thing from their duty to act as withholding agents for individual users. They are actual taxpayers themselves. It's a massive compliance load.
And what about foreign platforms? You might be wondering, are they immune just because they're headquartered offshore? Absolutely not. No way. The guidelines clearly state that non-residents are liable for tax based on significant economic presence, or SCP. Basically, if a foreign crypto exchange has a significant economic footprint in Nigeria, meaning they're actively serving Nigerian users and generating revenue there, they have to comply with the Nigeria Tax Act, just like any local business. For tax purposes, that digital border has essentially been erased. Next up, Section 4, Navigating Value-Added Tax, from Section 6.2.
Before we unpack VAT, let this be your quick little reminder to subscribe if you're finding this explainer helpful. We love bringing clarity to complex laws for you guys. Okay, so this slide perfectly illustrates one of the biggest myths floating around the crypto space right now. People are panicking, right? They think they owe 7.5% VAT every single time they send a Bitcoin. Not true. The actual transfer of ownership of the virtual asset itself is not a taxable supply for VAT. However, and this is a really big however, the services connected to that transaction are absolutely subject to VAT. We're talking exchange fees, brokerage commissions, custody fees, wallet management, the whole shebang. So the token transfer, VAT-free. But the fee the exchange charges you to execute that transfer, that definitely attracts VAT.
Furthermore, Section 6.2 explicitly warns that if you use virtual assets to buy taxable goods or services, VAT applies to the underlying supply exactly as if you had paid in fiat currency. Think about it like this. If you go to a store and buy a physical, vatable item, like a brand new laptop using your crypto, the vendor still has to account for and remit VAT on that purchase, and they have to do it in the currency of the transaction based on the fair market value. Crypto is definitely not a magical loophole to avoid sales tax.
Let's dive into Section 5, the 1.5% stamp duty, outlined in Section 6.3.
This introduces perhaps the most mechanically unique part of these entire new guidelines, 1.5%. I really want to pause deliberately on this number because it absolutely commands attention. Under Item 33 of the 9th Schedule to the Nigeria Tax Act, a 1.5% stamp duty applies specifically to token-to-fiat and fiat-to-token transfers. So what does that mean for you? Every single time you convert your Naira to crypto or your crypto back to Naira, this 1.5% duty comes into play. Every time.
Let's slowly walk through this chart together, because the mechanics here are actually pretty fascinating. The absolutely crucial rule to remember is this. The duty is always borne by the transferee of the token. That means the person who is receiving the crypto. So, if a buyer acquires a token with fiat, the buyer bears the duty. If a seller disposes of a token for fiat, the buyer on the other end of that trade bears the duty. For cross-border B2B payments converting Naira to tokens, the Nigerian business bears it. But here is the massive takeaway regarding the collection mechanism. The VASP, or the intermediary, withholds the stamp duty in token units, not fiat.
Let's look at a real-world scenario from Illustration 1 in the guidelines, just to make the math totally digestible for us. Okay, Step 1. User A pays 1 million Naira to acquire 1 Bitcoin. Step 2. The exchange, acting as the VASP, withholds the 1.5% stamp duty, which would be 0.015 BTC, directly in tokens. Step 3. User A is credited a net of 0.985 BTC. Now notice what happens to the fiat in this scenario. Absolutely nothing. The fiat remains completely untouched. The seller receives their full 1 million Naira, the 1.5% withholding strictly shrinks the crypto received, and then the VASP goes ahead and remits that 0.015 BTC to the Nigeria Revenue Service.
Finally, Section 6, avoiding costly crypto mistakes. To synthesize all of these rules into safe, compliant actions, we really have to look at this direct quote from Section 6.3. It states, "The stamp duty obligation crystallizes at the point of the token to fiat or fiat to token conversion in Nigeria and is not affected by the subsequent transmission of the token to an offshore recipient." Why does this matter so much? Because these guidelines are strict laws. Some people might think, oh, I'll just buy the crypto and immediately send it to an offshore wallet to bypass the Nigerian tax. Well, this rule explicitly shuts that down. The tax event happens the literal second the conversion takes place on Nigerian soil or via a Nigerian intermediary. Sending it away afterwards does not magically waive the liability that just crystallized. You're still on the hook.
And that brings us to the ultimate takeaway here. A single crypto transaction can trigger income tax, VAT on the exchange fees, and a 1.5% stamp duty withheld directly in tokens. It's a lot, right? But staying informed and compliant isn't just about following rules for the sake of it. It is quite literally the only viable way to protect your hard-earned crypto wealth from massive, unexpected penalties down the line. So I want to leave you with this question. Are your current trading habits and payroll systems actually ready for this level of compliance? Empower yourself with civic education. If this explainer brought you value today, please click that notification bell, subscribe to We in Law, and join us next time as we continue to decode the laws that shape our world. Thank you so much for learning with me.